Wells Fargo picking its top ideas in the financial space. The analyst Mike Mayo crowning Citigroup as his top pick, followed by Bank of America and JP Morgan. And if the Fed cuts rates, banks could, quote, party like it's 1995. Mike Mayo joins us now, Wells Fargo head of U.S. large cap banking research, joining us in New York. So, Mike, let's talk about it. It's a big call for a lot of people, a rate cut and a financials perform. Give me the why.
Well, the rate cut would be icing on the cake. We see the parallel to 1995. That was the beginning of the best bank stock performance in modern history. In 1995, like today, you had improving efficiency, deregulation, and the end of a Fed tightening cycle. And we have that already to the extent that the Fed cuts rates. That could be one extra catalyst for the large banks. So 1995 was known for Paisley ties. The San Francisco 49ers won the Super Bowl. You had Boris Yeltsin, Bill Clinton, John Major. But you also had bank stocks really just far outperforming. Bank stocks actually tripled for the 3-year period then, and the market doubled. So it was the best period of outperformance in a long while. And this time, going into it, the valuations are actually cheaper. And as opposed to the mid-90s, when you woke up every Monday wondering if a large bank was going to hurt you with an overpriced acquisition, now banks are returning record amounts of capital. So we are bulled up on the banks led by Citigroup here.
So, Mike, let's talk about that. It's an important point. The difference in the mid-90s, and you've written about it, the industry efficiencies that came around from the M&A boom. What is the equivalent in 2019?
Well, you have a record reduction in bank branches. You have a record reduction in employees. You have record revenues and earnings per employee. You have back office streamlining, and you have technology from AI to blockchain to the cloud to digital banking. This is making more of a difference than ever before. Pull the lens back a little bit. 1994 was the first time national banks could act like national banks. And then in the 90s, you had system integrations. Last decade, you had a financial crisis. This decade, you had regulatory change. So for the first time in 25 years, national banks can capitalize on being national banks. And you're seeing that more than any other place with regard to technology.
So, Mike, got to ask you about the rate cut call. Why is the rate cut the cherry on top? To some people, the idea of lower rates helping banks is almost foreign to them. What is it about the curve that could happen that could help some of these guys?
Look, all else equal, a steeper curve is good for banks. What I'd say is I brought my prop today. I know you like that sometimes.
You've always got a prop, Mike. Come on, what do you got?
Is this heads or tails? Can you see that closely enough? Well,
I can't see, Mike.
Well, it doesn't matter if you can't see, because if it's heads, that's what we expect. The economy seems pretty good from a bottom-up standpoint. Talking to the largest banks, and we just had a conference in Chicago a couple weeks ago, the largest banks are saying on the ground, credit quality is fine, commercial loan growth is fine. Yes, there's some crazies outside the banking industry, but the banks themselves are fine. So that's plan A, that's heads. But if it turns up tails and the economy is weaker than expected and the Fed's going to cut rates, you can't unsee yesterday. You see a dress rehearsal for what could happen with interest rates, and we think that would just be a partial start to what you would see in the bank stocks.